Hey there, community bankers. Welcome back to the Correspondent podcast, your go-to source for community banking content and resources. I'm your host, Madison Kaplinger, Marketing Associate at ICBB, and today we have some very special guests. Right now, I'm here with our CEO, Derek Hetherington, and coming up, you'll hear a conversation with our own Matt Evans, President of ICBI Affiliate Banker Service Corporation and namesake of the Evans Banking and Financial Services Program at EKU, and our friend Alan North, who is a Vice President at the Federal Reserve Bank of St. Louis. So the last year or so has been a bit turbulent for interest rates and the lending environment, and I know our community banks are feeling that especially. We talked with Alan and Matt about how community banks can monitor risks and prepare for possible economic hardship. Derek, I'm curious to hear your thoughts. What struggles are you seeing in our community banks and their lending departments?
Yeah, I think, Madison, you kind of nailed it right on the head that when you start looking at some of the unusual activity that we've seen, especially in the interest rate market and the kind of stubbornness of inflation, I think it's got a lot of community bankers just kind of, stepping back and, taking a broader look at what the potential economic recession or fallout from this activity could possibly be. And I think it's important, especially those that are old enough and have enough gray hair to remember the recessions in '07, '08. There's a lot of work that can be done on the front end when you start to kind of see some softening in the economy that can help kind of protect the bank and making sure that we're doing the right things. So, I think, definitely you're getting a chance to speak with Alan and, hearing his perspective on what the Fed's going to be focused on as banks start to prepare for this next exam cycle. And somebody like Matt Evans who can come in ahead of the, your next exam and kind of show you some of the things that they can do to help kind of test and stress some of the things that you're doing. It's going to be great to kind of talk to those guys. So I'm looking forward to it.
Yeah, for sure. I know we talked with Alan and Matt a bit about, things like risk management, asset quality, ALM, and back testing. Are you seeing some parallels between that '07, '08 recession and what's happening right now?
No, I think it's a completely different dynamic. I think in the last recession, I think it was just basically just driven by some dynamics that were causing the market to just it was influencing the market in an unrealized way. You had housing prices that were increasing that wasn't real. You had interest rates that were extremely low, and some structures of different types of loans that were allowing people to continue to leverage against value and property that wasn't real. It was it was all just kind of arbitrary. It was being driven by the fact that there was funding options out there. People were willing to buy these mortgage-backed securities at in a third tranche level with very low FICO scores and high loan to values. And I think that what we're looking at now is more of a dynamic of just the impact on the overall global economy, especially when you start to look at some of the impact it's had on supply chain demand. And I think that cost factor that's driving that inflation is different. I think that's more of a real inflation. The cost of transporting has gone up. The cost of people's livelihood has gone up. So what that's done is it's caused the cost to staff people to get supplies has increased. So even though I believe there will be a reset, I think people will have to back off because it's just you cannot sustain the cost increases without having equal increases in wages. But I think that coming out of the pandemic, a lot of people were locked up and just refused to go back indoors. Plus, there's still a lot of cash out there. I think there was a lot of things that were injected into the economy and some of the kind of response to COVID. And I think people are still sitting on some pretty large cash balances. I think that they still are able to, to manage and function even with the higher cost, relying on their savings account a little bit more for emergencies. So I think there's no real parallel of what I see in this versus that. But I think if you go back and study the history of recessions and what the impact it has on especially asset quality for banks and the impact it has on net interest margins, when you start looking at these big swings that we're seeing in the interest rate environment, it makes that ALM testing more important. And really, when we test that, we're looking at pretty large betas, 3%, 4% spread over 12 months. And you think about that, and you're They're like, well, when are we ever going to see that? Well, we just saw it. So what's going to be good now is I think a lot of banks are going to be able to step back and when they do their back testing, really look to see if their betas are correct rather than just using some formula. They're going to really be able to take a real world experience and say, hey, when we experienced a 3% spike, here's how our cost of funds moved. Here's what our, the beta should be for us to test this going forward. And then when you look at being at almost 0% interest for as long as we have been, now we're gonna have to start to test for that downturn. We start looking at the gap, we need to start saying, okay, well, there's a real, real opportunity going forward that if we have a recession, we could see rates really back off quickly in order to kind of soften the landing as we reset the economy. So we need to start looking at our testing for what kind of impact we're looking at for, a potential 3-4% decrease to offset the increases we've seen over the last year.
Yeah, for sure. Would you say that that's kind of the big takeaway, the one piece of advice that you would give to some of our community bank lenders as we head into kind of uncertain times in the lending environment, or is there something you would add to that?
I think for I came up on the lending side. I'm a lender to the core. So for me, I think when I start to look at, especially on new projects and development construction type projects, over the last year or so, I think banks have gotten more conservative in how they look and view budget contracts because cost overruns and stuff like that we're experiencing with the inflation and just supply chain demand and challenges there. I think now interest rate shocks are going to have to be a real thing. I don't know how stubborn inflation is going to be or how long these rates are going to hold, but I mean, I'm not banking on the idea that rates are going to come down anytime soon. I feel like that, you look at where we're at in interest rates now, we had, a long period of time there where interest rates were basically near zero. But if you look prior to that, that was just that was not something that was normal. We did not have near zero interest rates for that period of time ever before. So to think that we're going to go back to near zero at some point in the near future, in my opinion, I think would be probably fool's gold. So
Right.
so when you start to look at these loans that are going to be repricing in your portfolio, and you start thinking about if they're currently at a rate that you priced in 2019 or 2020 or 2021, and now they're coming up on a reprice on a 5-year adjustable or 3-year adjustable or coming out of the construction period and going to a fixed rate, you need to really be looking at that and shocking those rates to determine is that project's going to cash flow at the new interest rates we're seeing in the market today versus where they were at 3-4 years ago. Well, maybe we put that on the books. And as we put new loans on the books and we're looking at some of the challenges in the debt service coverage, you know, are we willing to accept a lower debt service coverage on the front end saying, oh, well, by the time this thing reprices, it's most likely the rate's going to be lower and it's going to cash flow better? Well, I would almost be on the adverse and say, well, if this thing gets shocked another 2-3%, can it still sustain a break even or can it still sustain a suitable debt service coverage that we're going to be comfortable with the risk in this loan? So I think that from my perspective, if I'm a banker, I'm concerned about what could happen in 2-3 years as we make decisions on credits and looking at how we look at debt service coverage and how we shock the interest rate against the debts that they're of those loans that they're issuing.
I think that makes a lot of sense to be a little more conservative heading into this period. Well, Derek, thank you so much for joining us and for joining us for the upcoming conversation with Alan and Matt. I think it's going to have a lot of value for our community bankers, and I can't wait for them to hear it.
Yeah. Thank you, Madison, for letting me join in on this conversation. I think it's going to be, kind of great to get some feedback from them. And obviously, I'm I'm taking it from the perspective of just a bank CEO that's sitting in my institution. Yeah, we've got a network of banks we talk with every day, so we get feedback, from our directors that consist of bank CEOs and from our respondent banks. So we have a pretty good, feel for what's going on in the industry and what banks are concerned about and having a lot of those in-depth conversations amongst the peers. But I think it's always good to hear from the auditors and the regulators on what are they focused on? What are they going to be
Mhm.
looking at? Because I think as we start to prepare for, we all want to run a safe and sound bank. But we also, need to have good partners that believe that we're doing the right things. And if we can kind of know what they're going to be focusing on, and we make sure to just incorporate some of these best practices back into what we do, it's going to make that whole exam process so much easier. So yeah, I'm excited to hear kind of what they have to say. And, obviously if we're doing everything right, at least it'll validate what we're doing. And if not, then I'll learn something today and we'll be better off at the end of it. So I'm looking forward to it.
Absolutely. Well, community bankers, here's our conversation with me and Derek and Alan North from the Federal Reserve and Matt Evans from Banker Service Corporation. All right, I am here with Alan North from the Federal Reserve Bank of St. Louis and Matt Evans of Banker Service Corporation. So to start, I'm just going to let you guys introduce yourselves and talk a little bit about what you do in your areas of expertise.
Well, hi, Madison. As you said, my name's Alan North. I'm with the Federal Reserve Bank of St. Louis, and I'm Vice President and Senior Officer here, responsible for community bank supervision. And with that, I also have IT and trust. And for your listeners, I have banks in 7 states, including Western Kentucky and Southern Illinois.
Thank you, Madison. This is Matt Evans, with President and CEO of Banker Service Corporation in Lexington. We are a bank consulting firm performing regulatory type services for community banks, loan review, compliance audit, internal audit, BSA, and so on and so forth. We do work for banks in multiple states, primarily focused in Kentucky, but other contiguous and surrounding states. So thank you so much for letting us be a part.
Yeah, thank you for joining us today. I know that, with some things that have been going on in the economy, our community banks are really kind of paying attention to interest rates and inflation and all those things and kind of figuring out their next steps of how to respond. So I thought you guys could be really helpful to be a part of that discussion for them. So with rates kind of rising over the last year and everything like that, are you guys seeing an impact in asset quality due to the pressure on debt service coverage or an increase in non-performing assets?
So, Madison, maybe I'll go first. I think right now, we're all kind of surprised that all of the metrics still show very little issues with credit quality. It kind of stands to reason as rates go up, borrowing costs are going to go up. Of course, other expenses for businesses will go up, which will cut into their margins. All those things should make debt service more difficult. But at this point, we really haven't seen much in the metrics. The one thing I'll say is the metrics are they lag, right? They're quarterly metrics, so they're not very forward looking. You can start to see some trends, but it takes a while. A couple of things that I think we've seen and things that we're looking at is commercial real estate continues to be a point of emphasis for us, and banks that are heavily concentrated, that they meet all the requirements of the regulatory guidance for commercial real estate. And for the most part, our banks, I think, are in pretty good shape with that, but we're asking our banks to take another look at that and do some scenario analysis too, to make sure that if things do go south, what does that look like from a capital planning standpoint? And then the last thing I would add about one reason I think we haven't seen the deterioration is, at least at this point, is that there still was a lot of cash in the system. I think it's starting to leave, and most of our banks, I think, would tell you that the surge deposits are gone out of their banks. But I do think that consumers still have a little bit of extra cash, so I think that's playing a role in this. And then finally, a lot of loans don't reprice that frequently. So if you think about it, most of these loans are still with lower interest rates. So I think that's a contributing factor. Now, as you see more and more refinance, obviously, then the whole issue of having a tighter debt service coverage is going to come into play.
And I'd just like to jump in and concur with Alan. From a loan review perspective, which is what BSC is doing in a lot of the local community banks, we are also not seeing the metrics change. However, what we are doing now and have been in a period of calm, is, I'm a paid pessimist. So, I'm paid to prepare my clients long before things go south. And that's kind of a tough thing to put a target on. When do you start tightening down? So we have been encouraging our clients to really go back to the fundamentals of credits. Are the 5 C's of credit there? Are you monitoring your CRE loans, your commercial real estate loans, are you doing all of the things that you should be doing? Are you following policy? And basically just normalizing all of the fundamentals there. And if we're seeing anything that looks like an outlier, may not have been a problem a year ago, we're bringing it to the forefront of our reports and to our clients' minds. So, but I agree with Alan. The metrics are still looking strong.
Well, and I might just one other thing I would add is if you look at the Federal Reserve Senior Loan Officer Survey that they conduct pretty frequently, and this is the first time where I've really seen that, basically credit criteria and lending underwriting standards are tightening, and the demand is starting to drop a little bit across all loan categories. So last year you saw that very prevalently in mortgages, but now you can see it in other commercial loan categories. So it might be a little bit of a harbinger of things to come. But I do think to Matt's point, most bankers are fairly pessimistic in terms of what they expect for 2023.
Interesting. I'm kind of surprised to hear that loan demand is decreasing across categories because it seems like, and of course, correct me if I'm wrong. I'm definitely not on your level on these subjects, but it seems like in 2020, 2021, demand was a little bit higher, especially like in the mortgage category.
Yeah. I think it's also, we always got to keep in mind this stuff is still very local. Certain municipalities are doing great. So like Nashville, for example, is obviously a metro area that's still booming. Conversely, I would say St. Louis is starting to kind of table off. And I think it a lot depends on what's going on locally.
Right.
And that senior loan officer survey too, the one thing to keep in mind, it's a national survey. It's really large banks. So it's really meant to try to give more of a broad spectrum. I will tell you, most of my community bankers will tell me that they have not tightened underwriting standards and the loan demand's still pretty decent.
One of the things that we've kind of seen as a trend is more frequently we're seeing banks trying to amortize the CRE credits on a 25-year amortization. And we've even seen some recently on 30 years. And we're even seeing appraisals that support that. And I'm like in my head thinking, as you guys go out and look at how banks are trying to make the cash flow work, you're looking at, cap ratios in the Nashville area in the 4.5% range. These things just to make the loan to values and make the debt coverages work for these loans is concerning, and we've been really kind of stressing with a lot of our banks that we participate with that just because the cash flows on a 30-year amortization at a 4.5% cap, you got a good collateral coverage. Is that the best structure, and is that really truly, are you collateralized what you think you are? And we've been getting a lot of pushback. Are you guys seeing that as kind of more of a universal kind of competition in the market that's pushing banks to do that? Or is it something that you guys are being critical of?
That's a really good point that you bring up, because you would expect cap rates to go up, right? Because if interest rates are going up, investors are going to want a higher rate of return. So I guess I would really question the 4.5% cap rate. In the appraisal, that's probably where our folks would start, is it's at the appraisal level, to say, does this seem appropriate given what you know about the market? And then I also think that you mentioned the term for amortization. This is probably not the time to take people out longer. When you think you kind of see storm clouds on the horizon, this probably isn't the time to loosen standards. So that would be the conversation we have. So Derek, you've worked with us a long time. We try not to make absolute statements, but to try to say, okay, what's directionally consistent with what you're seeing in the market?
That makes sense. So I hear you talking about, storm clouds on the horizon, tightening standards, things like that. So, that's going to come home to roost for, some more risk for these banks. So what measures do you see that maybe banks should be taking to monitor some of those risks?
Well, I might let Matt answer most of this question, but I will just say there's one thing that we've been advising our banks to do is to get ahead of this, so we know that these loans are going to reprice, right? And these borrowers can cash flow at their current rate, but if the rate goes up, 400 basis points, can they still cash flow? So what we've kind of said to our banks is, look out there 90 to 120 days, maybe even 6 months of the loans that are going to mature and you're going to have to refinance them at a higher rate, and start to talk to that borrower, start to understand where they are, to see if there's anything you can do to mitigate any challenges that they may be facing when you actually have to refinance this thing. Time is kind of on your side on some of these loans. And so the quicker you kind of jump in and take a look at it and then determine what might be some of the weaknesses and work with the borrower, there may be some options that you wouldn't have on the table if you waited. So that's kind of some of the advice that we've been giving, is to just try to get out in front of this as best you can.
Oh my gosh, Alan, that's like fantastic advice. And if there's one word that I could say, is shock, shock, shock. Shock those interest rates. Know exactly, do the analysis on the front end. Well, actually, shock, shock, shock is 3 words. But make sure that you're understanding the total picture here, because an ounce of prevention is worth a pound of cure. We want to see that type of analysis in the credit analysis write-ups that we look at. But storm clouds to me give an excellent opportunity for preparation. Are you doing the sound and conservative analyses on the front end? Does it make sense? Are you following the fundamentals here? Take it back to the fundamentals. And those are the types of things that we're looking for in our loan reviews and urging our clients to be on top of. We're just in a client that was doing quite a bit of out of area lending. Again, this just screams as a red flag to me. Go back to the fundamentals. Are you doing, the type of analysis that you need to? Are you equipped to do that type of lending? Are you including these in your concentration analysis that you're doing? Is the board aware that you're headed in this direction, and are they willing to accept the risk for going into that? But so to me, this creates an excellent opportunity to take a step back, look at the fundamentals, get your ducks in a row now, just in case things do hit that storm cloud.
Yeah, I couldn't have said that any better. This is a time to really kind of mind your P's and Q's in terms of underwriting.
And I think the difficult thing that we've kind of had with conversations with some of our respondents is this: we're coming out of this long period of basically no real asset quality issues. You almost had to try to have a bad loan over the last 4 or 5 years. And now it's like you have these borrowers that have been able to really leverage a lot in the last 4 or 5 years. And we've seen these, especially on the real estate investment side, individuals that have blown up in assets under management. And, and the thing that concerns me more than just maybe the loans we're looking at, what we've really kind of been stressing, and has always been kind of part of our underwriting, is that global cash flow. When you have somebody that has $100 million in real estate, leveraged with $70 million in debt, even though you may be only looking at a $5 million piece of their bucket, you may have the strongest piece, but that whole structure of, contingent debt and the potential for all that credit to reprice could be astronomical. So we've been really stressing the global cash flow and really digging into the strength of the total portfolio of these, large real estate investors versus just looking project based. And we get a lot of pushback because they're like, well, they don't want to provide 25 different tax returns for 25 different companies. And it's like, well, it's like they haven't had to for 5 years. So now they're like, why do I have to do that? And I haven't had to. And I think we've been trying to stress that people need to really kind of hold their borrowers accountable, say like, well, things have changed. The market has changed, rates have moved, credit risk has increased. We need to kind of move with it versus, allowing the past 5 years of sunshine to kind of, disinfect what we're getting ready to go into. So I know I could talk to you guys about credit risk all day long, and I'm sure all of our banks hopefully have this on their radar. But I know one thing that we've kind of been concerned about, even on ourselves, is there was a pretty good significant increase in loan activity that we saw over the last couple of years. And with all the kind of liquidity that jumped onto the balance sheets, banks were, pretty aggressive in loan growth over that time frame because they had a lot of, assets that were needing to be deployed, and rising rates. The bond portfolio wasn't as attractive, and you're getting some pretty good yields on the loan side. So now that you have this, I guess, I don't want to call it, the liquidity has not left the market, but as we start to see the liquidity tightening up, are you guys concerned, or have you, I guess, at the Fed level, seen any concerns with the cost of funds or the interest rate margins being compressed, and how that's impacting the bank's NOI?
Yeah, maybe I'll start with, it really depends on the balance sheet composition, right, and how they fund their assets. So a lot of our community banks, like the ones that you serve, Derek, a lot of those are so core deposit funded, they probably haven't had the pressure. While they probably had to increase rates a little bit, it hasn't kind of gotten out of control. In most of those banks, we've actually seen they have increased their margin just a little bit, because they've been fortunate enough to be able to price some loans at some higher rates. I will say the margin is not that compression we saw for years and years. I don't know that it's letting up that much in broad terms. But a couple things I would say, the banks that we have that have predominantly been more of a wholesale funded, where they've got more of a distribution of funding. They've got their core deposits, but then they may have some brokerage. They might have some rate boards that rate board deposits that could show up as core, but they're definitely different. And maybe even for a home loan bank borrowings, we see a fair amount of that. Those banks, they are getting some pressure because that we kind of mentioned it early on. There is some decline in core deposits. It's clear nationwide. You're seeing some core deposit runoff. So from my perspective, what we're trying to tell our banks is to think about maybe going back to 2019. As 2019 pre-pandemic, all of us will recall that the regulators had to start getting a little more comfortable with banks that weren't 100% core deposit funded, right? A lot of banks were using alternative sources, and that's okay. It's how you monitor it, the risk management around that, and really what's your risk tolerance, how you're going to go about managing all that. So those banks that have more of a mix of different funding sources, we are seeing a little bit of pressure there, more so than maybe we'd like to. And then the last thing I would say is it really depends on market too. The market competition is always a big driver of this. So some banks, I think, have really benefited from the increase in interest rates. They were asset sensitive, while others were maybe a little, believe it or not, some were liability sensitive in our portfolio, which kind of surprised me, to be honest, because we knew rates had to go up at some point. But nevertheless, it's been kind of a mix across the board. One thing I will say that I think is important mentioning is for those banks that instead of making loans are parking money in interest-bearing bank balances and those sorts that are Fed funds sold, those banks that bought securities, they're struggling a little bit because of the unrealized losses in the securities portfolio. And what happens then is if it gets to be too much of an issue, heaven forbid you get to a negative tangible equity or something like that, then liquidity is going to get more expensive for you. It just is, because some of the options are off the table.
So you touched on this a little bit just now, Alan, but given the impact that, recent rate hikes have had on bond portfolios, how's the Fed viewing the unrealized losses that banks are reporting due to changes in market value?
Yeah, this has been a tough issue because at first glance, it looks like it's an accounting issue, right? So if you designate your securities available for sale, which most banks do, basically that unrealized loss or gain shows up in accumulated other comprehensive income, which then gets neutralized from your capital calculations, your regulatory capital. But for GAAP, it doesn't. And so when you do the calculation, if you have a sizable amount of unrealized losses, you could end up in a negative tangible equity position, even though your regulatory capital ratios are still pretty good. So the way we try to talk about this is it would be expected that most banks will have some unrealized loss if they hold any securities to speak of. But when it really becomes an issue for us, or where we get, I guess, a little more serious in how we review it and what our conversations are with management, is when we get close to like the 5% tangible equity. That's when we start to look at it a little closer. And what we're really focused on is there a way to work through the market risk? And many times there's really not. If you do redesignate some of these securities as held to maturity, you're going to want to pick securities that are closer to maturing. If there is loss there, you're locking that in. We'll have to amortize that over the remaining life of that security. So there is some disincentive to do that. We have seen banks that will sell some winners and some losers at the same time to kind of break even, to reduce some of that exposure. But we're really going to focus on how you're managing that market risk. And then probably the most important piece is the liquidity risk, because if you don't have to sell those securities for liquidity, you're in pretty good shape. If you can hold on, eventually the market will change. When, who knows? It could be a long time, but at some point it will. And when that happens, then those unrealized losses start to dwindle, right? Heaven forbid, you might even be able to get to unrealized gain. Who knows? But the point is, if you have enough liquidity to get through it, and you don't have to sell those securities, you're still in pretty good shape. So we're going to spend a lot of time looking at how you're managing liquidity, and really what those sources and uses of funds might look like for some time to come, more than a year, maybe even 2 years, and try to make some judgment calls. I mean, we don't have a crystal ball, but I think you kind of have to look out in the future and say, what do you think might happen?
That kind of almost kind of brings me into my next thought that I had was, when you're starting to look at managing all this, obviously asset liability management and banks, really, doing some reporting and some testing, doing some rate shocks. As you're looking at that, obviously, we would use like a 3% rate shock to kind of determine potential impact. And all of a sudden we've realized that in a 6-month period. So it's like, when you're looking at that and going to the banks to talk to them about their ALM model, how they're doing their back testing and stuff like that, is there kind of a new expectation that a 3% shock maybe is not enough in that report? Or how are you guys kind of how conservative should banks be looking at it given the unprecedented rate environment we just saw?
Right. Well, I think that to maybe start the conversation, if the bank has really strong capital and earnings, then that market risk becomes maybe, I'm not saying it's less important, but you have room for error, right? If you have a really good capital levels and you've got strong earnings, you got some room for error. What we're going to do is we're going to go in and see how your model actually behaved, because we know now, right? We've had a time period where we had a sharp increase in interest rates, so we can kind of see how that model behaved and see if that's directionally consistent. We're always going to go back to the assumption. So what are the decay rates you're using? What are your betas that you're using? Does that all seem reasonable given your market, given your client base, given past experience? All these models that we use, they're driven by these assumptions, and these assumptions have to be tailored to the particular bank. So we're going to spend some time on that. And as far as additional, rate increases, I think it's probably prudent to go up 400 basis points, but now you also have to go down, right? So there for a long time, there wasn't anywhere to go down. And so that's part of the analysis too, is making sure you get both sides of the curve, or both ends of the curve, I should say. I think what we try to do is not change this too much from what a normal time would be. But I do think that the additional emphasis on, is this model working the way you think it should work, given your bank and where it's located?
Well, Matt, I know that you all do a lot of like the back testing on these ALM models. Is there anything that you guys are kind of seeing that, maybe you guys are doing to advise the banks as you kind of work through that process to help them, kind of determine, are their betas correct and are those models structured right?
Yeah. Go ahead, Matt.
No, we are doing, quite a bit of back testing of ALM models. And I am fairly certain that we're using the 400 basis points that Alan talked about. Now that, wasn't always like that. But I think about maybe 2 or 3 years ago, we adjusted that. but that has been one of the main emphasis that we've, been the changes that we've made over the past few years. But yeah, Derek, I mean, we're still focusing on that quite a bit in the back testing of the models.
Well, I know that this rate cycle hopefully can't last forever. I think that if you have cash, you're actually pretty happy that the savings rate now is higher than 0%. But one would assume, and a lot of the kind of economists have kind of declared that there's going to be some form of a recession or a cooling of the economy at some point. So as we kind of look at that, obviously asset quality is always a concern whenever you have a downturn in the economy. You start having declining interest rates. Obviously, then you have to look at your gap, because if your assets are going to start to reprice faster than your liabilities, then that interest rate margin could become an even bigger issue. And then, obviously with the ALM testing, it's going to be important. Is there kind of anything outside of just the general management of that balance sheet and the kind of the portfolio management and asset quality that banks that I as a banker that's been in the business for 20 years have never seen a rate environment like this, or an economy like this. So kind of thinking back historically, is there other things we need to be looking at, thinking about, putting on the radar? Is just like, hey, we don't want to focus too much just on loans and asset liability management and the funding side over here. There's something over here that could possibly be impacted that we haven't had to deal with because we just haven't had this kind of environment that we could possibly be coming upon. Just as a refresher for the young bankers in the room, I guess.
Well, maybe I'll start and let Matt jump in. I think the one thing that even if you're a small community bank, you need to do some capital planning. And what I mean by that is kind of some scenario analysis. And so what you might do is, if you're a really small community bank, you might take your 10 largest relationships and to say, okay, what do they consist of? And, let's come up with a couple of scenarios, something kind of a base case that's reasonable, could happen. And then maybe a case that you think, gosh, that's probably not going to happen. But if it does, it's going to hurt. And then when you go through that process, you do the math, you see what the impact of capital is going to be. That's really important because now it's giving you a window into, do we have enough capital? Is our reserve enough? And if you don't think it is, then start making moves to get it there. Obviously, it's tough, right? Raising capital is not an easy thing to do, particularly in a small community bank. But there are things you can do over time that will improve that capital position. Certainly, you can improve your reserve. We haven't talked much about loan loss reserve and because our wonderful friend Cecil, but making sure those reserves are good. And I will tell you, I know accountants, I know our bankers sometimes struggle with trying to meet in the middle between what the regulators want and what the accountants want. But for the most part, banks that are not publicly traded, having a little extra in the reserve and keeping it there is a very good thing. The one thing I've witnessed during the pandemic was when we first had the first CECL adopters, those reserves went way up because everybody was scared to death, right? The pandemic hit, and then they went way down by the end of the year. I don't think that's healthy. I don't think a reserve should go up and down, up and down. If I'm a banker, I would prefer to have a nice, healthy reserve. And as times change, yeah, I'll add a little to it. But if you think about it, if you already have a healthy reserve, you don't have to provide as much when you do need to kind of start to add to it. So one of the messages I always have is if you have a strong reserve and you think about capital levels for the future, you're probably going to be fairly well positioned to deal with a downturn.
Alan, I tell you, I echo, and from the loan review credit side, and I definitely think we could do another one of these talking about the ACL, the allowance for credit loss, and CECL. We are spending a lot of our time discussing the approach going forward and how we're going to approach what we do. But the reserve is very important. I know banks are very busy right now dealing with the changes. We are doing some model validations now for banks who have basically homegrown their own models here. So that's been an interesting thing for us. So there's a learning curve there. But I really love your idea, Alan, about, really testing some of those top credits in the bank to see, really shocking those credits to see where those land with interest rates. So I'm taking notes, Alan. That was a good suggestion. I'll pass that one along.
Yeah, this is really good stuff, guys. Thank you. So the last thing that I want to ask you guys is, a lot of the, top economists are, predicting this recession, however, you know, hard or easy it will be. But, the pendulum always swings the other way. After a recession comes a recovery. And as I'm, reading through banking content and a lot of the top voices in banking, a concern is that some measures that a bank may take to help themselves during a recession may cripple them during a recovery. So I was just wondering if you could speak to that, given some of the advice that you've given um, during this podcast, and or is that is that more of a moot point? Like what helps you during a recession will help you during a recovery. I'm just curious as to your perspective on that, as far as the advice you've given.
Yeah, that's a fair question. As I talked about the allowance and capital levels, I think that'll work. It works for you no matter what kind of scenario you're in. The one thing I would say, and maybe this is fairly intuitive, but I do see bankers that, I would avoid going long on anything right now to the degree you can. Obviously, when you're originating loans, that's a little bit of a different animal than buying securities. But I still have, believe it or not, seen some bankers going long on some securities, and I don't really understand the thought process on that. I guess one might say, well, if I think rates are going to drop, let's go ahead and get the return I can get, lock it in. I think one of the things we always tell banks is don't try to predict what rates are going to do, because you just can't. It's like trying to predict the stock market. You'll end up on the short end
Yep.
easily if you start to do that. So that's been some advice that we've kind of given. It is amazing, as you mentioned some of the things that have been said about the economy, and some hope for a soft landing. I know the Fed hopes for a soft landing. That's what we say publicly.
Right.
So all of those things. I think if you look at the economy overall, you got to look at it for a longer term than just what's this quarter, what's next quarter. You really need to be looking a couple of years down the road. And I think if you do that, that's going to position you better, because you're going to have some volatility, and I would suspect we'll have a little bit of volatility at some point in the economy that maybe we didn't think about. So I don't know. My advice is usually try to have a longer term look to what your future looks like, rather than what's tomorrow going to bring. It's probably more important to know what 2 years is going to bring, that sort of thing.
Hey, Alan, I have a comment, but really my comment's more of a question, and it's relevant here. In dealing with a tight labor market, we talk about on a macro perspective, but in the banking industry, I don't know about what you're seeing from a regulatory standpoint, but we're seeing banks really struggle to attract and retain credit analysts. And that's a catch-22. And if you don't have the people, and we're also seeing a lot of banks promoting those folks from within the bank. I mean, that's a very highly coveted skill set. But that really does get to the heart of being able to do the analysis, to be on the front end of these things. Are you seeing that on a big picture from the regulatory side?
Yeah, so our smaller community banks tend to get by because they'll hire a firm like yours, Matt. The larger banks, particularly here in St. Louis, you wouldn't believe what they're paying these credit analysts that have been doing it for 2 or 3 years out of school. And the problem, as I see, is they didn't go through the Great Recession. I will tell you, my oldest son is a credit analyst with a very large regional bank here in St. Louis. And, he's a smart kid, but he hasn't lived through the Great Recession and hasn't lived through a more questionable credit cycle yet. So I think it's a kind of a double-edged thing, Matt. I mean, it's kind of double-edged in the right way. I would say it's more of an exponential problem, because you don't have folks doing it. And then the folks you do have doing it don't have the experience level. They don't have, the gray hair that you have, Matt. So that's, to me, that's what we focus more on, is do they have the right people? And then when they're doing those loan reviews, are they thinking about the types of things, Matt, that you would think about?
Yeah. Alan, I think what you meant to say was lack of hair, not great hair. But I appreciate you confirming that. What seems to be like an issue that maybe is isolated to one or two, it does seem to be a fairly systemic issue on what we're seeing. We've gone through the whole, compliance officers are hard to find, BSA officers are hard to find. I mean, we're dealing with credit analysts, which really gets to the heart of asset quality and credit management. So thanks for confirming that.
Well, and I'll go a step further. We're concerned with our examiners, making sure that we get them up to speed, because the Great Recession, a long time ago now. If you really stop and think about it, it's a long time ago. We've been in this great credit environment forever and a day. We know it's not going to last much longer. We expect that it won't last much longer. And, a lot of our examiners, heck, I got folks that have been on 7, 8, 9 years, and some of them tell me they haven't even downgraded a credit. So that's kind of where we are. So the Federal Reserve, we're trying to get those folks up to speed, but that takes additional training, a whole lot of case studies, a whole lot of conversations with more senior examiners.
Well, I can speak on behalf of myself, and I'm sure there's other banks out there that would echo what I'm about to say. But I've obviously worked with both of you very closely. Matt, we engage you and your team on our loan review and our audits, and being a Fed member, state bank, we've gone through the exam process with the Federal Reserve. I've been bank CEO for 3 years, and we've had a few conversations, Alan, that were kind of, pandemic related and economic related. That, as a banker's bank, we tend to be an aggregate of the industry. So when banks are seeing liquidity across the market, we're seeing it times 100. When they're, so our concern is if there's asset quality issues, as a banker's bank, we tend to have a very high level of asset quality requirement for us to do participations and stuff. So I just want to thank you guys both for being here today and kind of giving us the opportunity to just kind of pick your brain a little bit and share this with our banks, because I know we've had conversations one-on-one, and I just felt like the way you guys approach it is more of a collaborative, supportive way of trying to help these community banks navigate this as a partner. Obviously, Matt, like you said, you're the one that comes in to try to tell them the bad news before they have to go see the doctor. Then obviously, Alan, when your team comes in, if they haven't fixed it, they have to take their medicine. I always encourage our banks, use the resources that are there before it becomes an issue. I think both of you guys have been great to work with. Again, I appreciate you guys giving us time today. And obviously, if there's anything that our banks have questions or concerns about, I always encourage them to reach out to us. And obviously, Matt, I know you and your team would be more than happy to, discuss anything that they have concerns about. And obviously, if they're a Fed member bank, Alan, I know your team would love to help them as well. And if they're not, I'm sure you would love to pick them up as a member.
Well, thanks for the opportunity, and hopefully you'll invite me back. This was fun this afternoon.
Absolutely.
Thanks a lot. We enjoyed it.
Thank you guys so much for listening, and I hope you've gotten some value from this conversation to take back to your community bank. Make sure to follow or subscribe to The Correspondent wherever you get your podcasts, and turn on notifications so you never miss a new episode. See you next time.